Rohr here with an early global view on Wednesday, February 18th, 2015. It's currently 7 a.m. U.S. Central Time, and along with the data, there are important macro factors affecting the markets. We'll be back to those shortly, but we raise the question of, with the turmoil elsewhere, why are equities doing so well? Well, you might have to start considering the cheapness of energy, as crude oil remains relatively down. So, what does all this mean to the markets? On balance, it seems to suggest that so far the equities have liked and the govies have disliked what's going on. And as you can see, since we did our analysis late last week, when the S&P was first pushing up into that old high back at the 2088.70 area and managed to push above it, even getting out into Friday, where the market actually ended up pushing above 1290, which into this week was a very important oscillator resistance, and finally made it above it on Monday in a more meaningful way. So as of right now, just to put the big picture in context here on the short-term view, if you can remain out above 2090, did I say 1290 before? 2090. If you can remain out above it, then you're looking at 2,120 to 2,125 this week as the next resistance. And that moves up about $5 a week. Now, as far as supports, what's interesting here is that the market has not been able to even knock out the aggressive channel since the last modest dip back into the 2037 area, going back to Monday of last week. And what's important about that is that it has secondary support below that, even if it should dip down, let's say late today, into the 2090 area again. So whether the bears can at least get this to get back below that oscillator projection is very important right now. And if not, look for it to continue higher. Even if it should break down further, you have support back at around the old 2088 high on congestion, but more importantly, there was an important old congestion below that from back in December at about the 2078 to 75 area. And that's reinforced by the gap higher from last week Thursday. And that was part of getting out through 2060 in a meaningful way, and not being able to flip back below it later part of last week was part of the strength. And now we look to 2075 to 78 as good initial support on the gap, as well as all of the previous congestion. And along the way, we also mentioned that the hourly MACD is remaining out above its upper runaway band. This was a real question as well, as the market faltered temporarily around the 2060 area going back to Wednesday of last week. But once it started to show strength again, while this doesn't look very impressive in its own right, unless and until it's back below that upper runaway band, the rally will tend to feed on itself. And that's pretty much it for the short-term view of the S&P 500.